Well, welcome back to Finance Uncut. On today's episode, $200 silver and $8,000 gold in 2023. So I did this video a couple of weeks ago where David Hunter talks about a stock market crash and this deflationary bust, which then gives the permission for central banks to just put their foot to the floor and just create unlimited amounts of currency, and then we get this high inflation environment. Others say hyperinflation environment, and then where he goes on to say that over this coming decade, silver will hit 300, gold 10,000. If you haven't watched it, I'll put a link in the description below. But just this video, there's a few similarities between this video and that one.
So, Michael, last question for you. You mentioned that it was your view that gold and silver will probably outperform any other commodity if we want to talk about gold and silver as commodities. What's your preference between gold and silver? Do you have one?
Yes, I do. Silver's vastly underperformed gold since the 2011 high. When silver was up near 50 for the second time in its history. It was there in 1980. And gold was at 1911. And they both turned down. Gold turned down short of 50%. Silver turned down much more. It went down to 10, 11 bucks at one point. So on a relative performance basis, it is underperformed. But that changed last summer when silver broke out via our annual momentum structures. It broke out to the upside last July at a price of $19.48. Within 3 weeks, it was $10 above there. There was a 50% gain in 3 weeks when it broke out. Well, at that point that its price surged, its spread relationship to gold also broke out, breaking the backbone of its downtrend in performance that had been underway since 2011. So now silver is an outperformer to gold when you measure month to month and so forth. Don't pay attention day to day. But we think it will continue to be an outperformer, and we also think that when you look at the miners, gold or silver, you probably would do better buying a bunch of silver miners as opposed to gold miners on a percentage gain basis. We think silver is vastly undervalued, and our bet is the following. If silver comes up out of this recent range of action, which has basically been $29 on down. It's spiked up over 30 briefly, 29 to 22 between last summer's high and the low in September last year. Right now we're trading either side of 28. Come out of this range, and we think it's going to do it soon, and get it back up above 30, that it's going to move rapidly toward those old two highs it made in 1980 and in 2011. It was at 50 bucks. That will be the third time, if it gets there, it'll be the third time it's been there in history. We think that is going to be a triple top breakout. And we think silver will gain value such that it reflects what gold has done over the last 40 years or so, where gold at each of its peaks makes new highs. If silver would reflect gold even at its current value, such that it was reflecting what was going on back in the mid-1970s, silver would be about $200 an ounce right now. And it wouldn't surprise us that we go there. And that if we go there rapidly. Look at a Bitcoin chart, for example, between mid-year last year and January, February of this year, in terms of percentage gain. It wouldn't shock us that silver becomes over the next 9 to 12 months, the next Bitcoin in terms of upside panic. So we'd emphasize silver.
I wanted to share this chart because it kind of lines up with what David Hunter has been saying, and even some deflationists like Hoz and Henrik Zeberg and Brent Johnson, where they say we're going to go into deflation first, and then even hyperinflation. So we can see commodity and food prices rising. We better increase inflation expectations, and then it says you're here. It's just temporary factors such as oil and used cars. We don't care about even huge upside surprises. We are kind of there, right? And then year-on-year effects are fading in oil, food, and car prices. See, it was all just temporary or transitory. In my last video, I talked about, and I showed a chart that showed the CPI numbers in the 70s, where it went up, came back down, skyrocketed up, came back down, skyrocketed back up. And what you'll have is these people come out and say, yep, see, told you it was transitory. Yep, we're going into disinflation or deflation now. But then we go to the final little blue bubble there. Oops, rent of shelter prints at around 4%, while core inflation remains sticky above 3%. Fed tapers and markets are surprised. And I actually think this is a good chance of happening, that markets, the debt bubble could be popped if CPI, if everyone starts to no longer believe central banks' transitory claims and actually think, you know what, my currency is getting debased. I'm losing value holding these dollars. I'm going to go put them into real assets, hard assets like gold and silver. And then the central banks decide, you know what, we need to do something about CPI. And if they do taper, and I've said this before, if they do taper and rates rise, then we are going to see markets crash. We're going to see all markets crash. And, if the stock market crashes, if the property market starts crashing, we will see gold and silver go down, because the amount of margin debt in the system means that even people with gold and silver will sell it to get liquidity, to cover margin calls. And so we will see gold and silver fall off if that's the case. But what will happen at that point is it will give central banks and governments a license to just print. Like they will turn on the NOS and put their foot down. And maybe we do get hyperinflation at that point. I shared this in another video as well. Total margin debt, .com bubble, it was 450 billion. Great recession, 400 billion. Now we've got 850 billion in margin debt. This is very much like the bubble in the synthetic asset-backed CDOs before the great financial crisis. So this could be quite devastating on the way down. And central banks, I think, will do whatever they can and put the foot to the floor when this happens, which I think is going to create other issues in terms of the value of the currency. And speaking of risks, risk.net, JP Morgan warns hedge funds to expect intraday margin calls. So there's so much risk, folks. I hope you're getting the message that there's so much debt, that everything is in such a big bubble. And there's so much counterparty risk out there in financial markets as well. And this is why I like holding physical gold and silver. Doesn't have any counterparty risk. In a market sell-off, as I said, gold and silver can get sold off as well. That's a short-term problem. All it means is I'll just increase my holdings when and if that happens. I mean, look at how overvalued our market is. Total market cap to GDP, 207%. This is a bubble. Look at the .com bubble back then. Look at it now. Or the great Peter Lynch, his rule of 20 valuation method. I mean, we thought that the .com bubble was a bubble. And it was a bubble. And it was very expensive. Look at it now. Real earnings yield of the S&P 500. Never been this low. But have a look at all the other times that it's been this low, and have a look at what happened to the S&P 500. So there's huge risks in the stock market. Now, do I own stocks? Yeah, I do. I've got stocks in certain sectors. I've shared this before. I own gold and silver miners and explorers. I've got other commodities stocks that I hold, and I've got some biotech positions. That's about it. I don't hold any growth or tech stocks or bank stocks or anything like that. And I agree with some of the smartest investors, like Stan Druckenmiller and Jeff Gunlock and whatnot, that basically say if you're buying into the market now, that really for the next decade, and I actually think more, because I think we're going to have an inflationary decade. So I think when you're looking at real returns moving forward, so if you're buying the stock market today, I think you're going to get negative real returns for the next decade or more. So, you know, I mean, there's just so much risk. And, you know, you have a look at any chart, go back to 1929. What did it take? 26 years to get back to that peak. You know, this is what we're talking about. You have a look at the 1970s period, and when you adjust it for inflation, we know that 73, 74, we had a 50% crash in nominal terms, but you have a look at the whole decade. You made no money in real terms. You made no gains in real terms on the index. And while we're at it, survey, bad time to buy a house due to price. Never been higher. Never been higher. So I can tell you I am very, very happy that I've been selling my real estate over the last 12 months into this crazy bull market, this insane bull market. And it's not just in the US. Australia has the same problem. Canada, New Zealand, UK, you name it. It's happening all around the world, in the West anyway. And yeah, young first home buyers, and we see it here in Australia. The government created a whole bunch of incentives and free giveaways, and take money out of your retirement accounts and build a new home, and we'll give you X, Y, Z. I've said it in other videos. You could have got up to a first home buyer that had zero savings, could have got $85,000 in different grants and different giveaways, plus some stamp duty concessions. So I didn't even talk about them, or mortgage insurance concessions. So I didn't even add those into the account. But $85,000 as a deposit to buy a house, and we saw that. We've seen that, and so a lot of first home buyers have jumped in at all-time highs here in Australia on Australian real estate at record low interest rates. Although we've been seeing the 4 and 5 year fixed rates rise, we don't have the 30-year fixed rates that the US do. We've got a couple of banks that will do a 10-year fixed rate. Otherwise, really the longest fixed rate that we have in Australia is a 5-year fixed rate, and then you revert back to variable or refix it again for another 5 years if you want. So, yeah, I feel very comfortable in selling my real estate. So I still got a couple of cash flow properties left, which I won't sell because they never really boomed before the crash in 08. They never really crashed after 08, and they haven't really gone up a heck of a lot. And those couple of properties are in Memphis, in the US. So I've shared this chart in other videos where we've seen huge amounts of currency creation, okay, versus the gold production, silver production. However, if we do have this market crash, that will give a license to central banks and governments to absolutely turn on the printing presses. We could see huge changes coming, and you'll see shortly in the next couple of pictures I've got, or graphs, where I think things are going. But that currency creation, I think that is going to skyrocket even from this. And that means that gold and silver production, you can't just print gold, you can't print silver. I think the value of gold and silver is going to become very precious. They're precious metals. I think they're going to become very precious as we continue to debase the currency and create more of it. Not sure if you guys saw this article in the Financial Times. For sustainable finance to work, we will need central planning. Now, just look at what the World Economic Forum are pushing. Look at the ECB, the IMF. Mark Carney, the former Canadian and UK central banker. I mean, US, Australia, it doesn't matter where you go. There is a push now for socialism, central planning. These technocrats running things. MMT, UBI, you name it. Things are changing. I mean, we don't have capitalism anymore. I've talked about that in other videos. We have what I can't think of his name. Austrian economist says that we've now got corporatism. In fact, he said that the death of capitalism will be corporatism or cronyism, and will ultimately lead to socialism and central planning. And that's where we are right now. And on the 9th of July, I shared this in another video, the IMF and World Bank advocate for benefits of central bank issued digital currencies at the G20. Now look what's just come out. Digital euro from the ECB. We have decided to launch the investigation phase of a digital euro project. Folks, I think the ECB might be the first major Western nation or bloc that brings out a central bank digital currency. From what I'm hearing, that this investigation phase is to go for the rest of this year, and that the digital euro will be implemented in 2022. And we know that Chairman Powell has now embraced central bank digital currency as well, a Fed coin, a digital coin. Only 18 months ago, I remember hearing him say that they have no plans for that, no desire, there's no benefits. Well, now he's changed tune, and he's talking about the amazing benefits of a digital dollar, and so that's coming. And what's interesting, I found out that actually the Fed actually put out a white paper on a central bank digital currency or a digital dollar in 2014. I wasn't aware of that. So we're going to get more central planning. I've got no doubt about that. We're going to lose privacy with the CBDCs, but that also is going to help central banks be able to increase and play with the currency supply and to direct it to where they want it to go. This central planning, it's like, all right, we're going to give UBI to everybody. You've got $2,000 this month, and you have to spend it on this or that. I mean, that they've got so much control, and it's a failed plan. I don't know why they haven't looked at Soviet Russia and went, well, this kind of thing didn't work. This central planning idea. I mean, Ludwig von Mises just smashed the idea of central planning and socialism. So many socialists back then actually agreed with Ludwig von Mises and said, you know what, you're right. And I think Friedrich Hayek himself lent towards that, as a young man, led towards that socialist type of view until he read Mises's book, and he was absolutely convinced that Mises was right. Yet here we are. We don't learn from history. Anyway, so if we see currency creation being increased and the debasement of currencies continuing, then I believe the underlying assets, commodities, gold and silver is going to increase in the years ahead, which also is great news for miners. And Michael talked about that, talked about miners. He in particular talked about silver miners. And I absolutely agree with him. And in this chart, we can see the commodity prices versus marginal cost of production. And here's a different, you can see copper and gold, zinc, iron ore. Iron ore is huge, but these are wonderful profit or profit margins for miners. And if as I said, if the debasement of currencies continue, then these commodities prices are going to continue to rise, and that's good news. That's good news for the miners. I've shared this before, but gold and silver miners' median free cash flow yield just continues to increase, and I expect it to continue increasing. I am so bullish on these things, but they've been underloved for a little bit now. But I've invested in this space for a long time, and when you're patient, you do get rewarded. So I've shared before that I use Austrian economics for my analysis and for my investing. I use it to get an idea of where the economy is at, where the economy is heading, and in particular from a macro point of view. What that tells me is which sectors and asset classes to perhaps go into. When I then get into those asset classes, I then use fundamental value analysis to then determine which actual investments to buy. Now, I am predominantly an investor. I do a little bit of trading. Okay, now I don't trade. I don't buy options. I've got friends that do well, that buy options, sell options on the same day, the next week. They're in and out. They're just making percentages, 2% a day or whatever, and they do well. They have a lot of losses as well, but they trade. That's their business. That's their income. That's how they generated income. That's not for me. I've got other guys that I know that swing trade, and once again, they do it as a business. That's their income. That's what they do. That's not for me. I even know some guys that have done really well trading CFDs. CFDs scare the crap out of me. So I don't do those trades. Not to say that they're not bad. As I said, I've got friends that make a living doing that. It's just not me. But what I do is, as I said, I'm a fundamental value investor, first and foremost. I am predominantly a seller of options rather than a buyer. I do buy, and I'll come to that. But I sell out of the money covered calls on stocks that I want to own. So I sell out of the money covered calls, and I sell them with short-term expiries because I don't want the person buying the option time to be right. And I also sell out of the money covered calls because I don't want to be exercised, because I want to own these stocks, but I just want to pick up some extra income along the way. And so I average about 2% a month. I've shared that before. And actually, I've done a video on this, so I'll put a link in the description below if you want to learn more. Watch that video and go for it. And I sell naked puts on stocks that I want to own. So I provide insurance to the market. Say if the stock falls XYZ, I'm happy to buy it off you at XYZ. And so I'm either picking the stock up that I wanted to buy anyway at a wholesale price, or I get paid and I don't pick the stock up. So that's what I do predominantly each and every single month. That is my bread and butter. That is a core part of my overall portfolio management. I then do probably two other trades. So this is the buying of options part. So I buy leap options. They're basically just long-term call options. So long-dated options. Usually minimum 12-month expiration. And I might only do these maybe 3 or 4 times a year when I see certain opportunities that pop up, and I'll jump on it. And I have that long-term expiry because I want to buy myself time to be right on my analysis of a particular opportunity. But for me, buying options, usually you're just throwing money back to the market or currency back to the market. And so as a short-term trader, I'm not that very good. But when I see certain opportunities, I can buy myself time to be right and allow that to play out. And that's worked really, really well for me. The other one that I do is in down markets, bear markets, I trade bear call spreads. And I shared in other videos in March last year when the market sold off that we used this trade, and we used just straight out put options on individual stocks, and in 2.5 weeks we made 780% gain. So yes, I do a little bit of trading, but it's just down to those 4 particular trades. My trading is very simple. I sell options each and every month, and I buy long-term call options or leap options for specific scenarios when I see opportunities. Don't do it very often. And bear call spreads or put options, I do that even less than that, because only when there's a genuine market downturn or bear market or crash that I do that, or there's a particular stock, like in Australia, AMP was an absolute basket case of a stock. Went from what, $8 down under $1. There was that law firm as well. It escapes me. I don't even know if it's still operating. So there are some other opportunities when stocks are going up, where the market's going up, but there's a couple of individual stocks that are in big trouble, and they do tumble. And I generally wait. I don't get in too early on those. I make sure that this stock is tumbling, and the short sellers are really shorting it, and then I jump in. I don't make the huge profits usually. I'm looking for like a 300% gain on that, and usually I get it 300 to 400% gain is usually what I do. But my basis is a fundamental value investing, and in this chart, when we look at the comparison between gold miners and the S&P 500, clearly this is one of the reasons. Obviously, the whole macro outlook and the debasement of currencies and gold and silver, yes, but just from a fundamental value point of view, I want to own the miners. So when we look at the valuation, gold miners are a third of the valuation of the S&P 500. They are cheap. When we look at the free cash flow yield, miners, or gold miners in particular, have double that of the S&P 500. Return on capital, 50% higher. Now, here the gold miners, we got 10.3. The gold miners that I own, the individual gold miners that I own, for the last 5 or 6 years, their return on capital has been well over 20%. Return on equity as well, over 20. So, gold miners, much better than the S&P 500. And I've shared in other videos charts of gold miners in terms of their balance sheet and debt. They have really cleaned up their balance sheet and their debt over the last 5 or so years, 6 years or whatever. So you can see that, compared to the S&P 500, their net debt is a fraction of the S&P 500. And then profit margins, well, we've seen that the profit margins are double that of the S&P 500. So just from a fundamental value point of view, gold miners make much more sense. And I love buying undervalued stocks. I love receiving dividends. I love selling out of the money cover calls. I love my stocks when they're boring. I don't get emotional chasing these Tesla stocks or in Australia, the Afterpay stocks. In fact, no, I won't say it. I won't say it in this video. I almost let maybe a cat out of the bag and maybe a particular trade that I might be doing, or I could be in trouble because that could be seen as giving financial advice. So I'll keep that one quiet. But this is why I love investing in this space. I love being boring, because being boring and sitting there and just the old Jim Rogers idea, just sit in the corner of the room and wait for the market to just drop that cash on the floor and go and pick it up and then go back to the corner of the room. I mean, it's pretty simple. Anyway, that's my opinion. What do you guys think? If you like this video, hit that like button. Give us that thumbs up. Really appreciate it, guys. If you haven't yet subscribed, do so. Hit that notification bell. Take care, everyone, and I'll see you again on another episode of Finance Uncut.